The Federal Reserve just cut interest rates again, the latest in a series of cuts aimed at supporting a slowing economy and easing borrowing conditions across the entire financial system. For commercial real estate investors, CRE investors, both institutional and retail investors, this moment isn't just a headline, it's a decision point. Rate cuts ripple through every layer of CRE, from cap rates and valuations to tenant demand to fund level returns and investor allocations. Today, we're breaking down what smart capital does next and why this environment matters, especially for shopping center real estate and for investors evaluating opportunities within our strategy at Rockstep Capital. Let's start with the basics. When the Fed cuts the federal funds rate, most recently lowering it into the 3.5% to 3.75% range, the lowest level in roughly 3 years, it directly reduces short-term borrowing costs in the banking system. But here's the nuance. The Fed doesn't control the interest rate CRE investors borrow at. What they do influence is short-term base rates, which feed into SOFR, prime, and CRE loan pricing, investor expectations about future economic conditions, treasury yields indirectly, which shape long-term CRE debt costs and cap rate trends. What's a translation? Debt becomes cheaper. Capital becomes more active. Risk appetite increases, and asset values often begin to rise before lenders and appraisers fully adjust. This is why rate cuts tend to unlock transaction volume in CRE, something the market has been waiting for since 2022. So how do rate cuts change investment behavior? Institutions like pension funds, insurance companies, REITs, family offices, they think in terms of relative returns. After a rate cut, treasury yields decline, reducing expected returns on bonds. CRE spreads look more attractive relative to fixed income. Leverage becomes accretive again because borrowing costs fall faster than cap rates adjust. And portfolio managers start rebalancing toward real assets with strong cash flow. This usually leads to increased demand for stabilized or value-add retail because retail cap rates generally sit higher than multifamily or industrial, offering better risk-adjusted yield. Retail investors respond differently. Their savings accounts and CDs drop in yield after rate cuts. They look for higher, more stable income, especially in income-producing CRE. They prefer accessible investment vehicles, like private funds, instead of owning buildings directly. They care less about cap rate spreads and more about distributions, stability, long-term appreciation. Both investor types, whether it's institutional or retail, end up more open to CRE allocations during easing cycles, but for different reasons. This is where the story gets more interesting. 1, retail tenant demand rises earlier in rate cut cycles. And when borrowing costs fall, businesses expand, franchisees open new locations, service-oriented tenants like gyms, medical office, restaurants, they accelerate their leasing. Necessity-based shopping centers are often first in line to capture this demand. Number 2, lower rates improve the debt service coverage ratio, the DSCR, and loan sizing. Lower interest rates mean higher debt service coverage ratios, more favorable financing terms, larger loan proceeds. For value-add retail, this means more leverage that's available after stabilization, which improves investor returns. Third, cap rates don't immediately adjust, but they will. Cap rates lag interest rates. This creates a temporary window where borrowing costs fall, cap rates stay the same, cash-on-cash returns increase, and pricing has not yet inflated. Smart capital moves in this window before valuations rise. 4, retail is still undervalued relative to other CRE sectors. retail, especially shopping centers, still trades at higher cap rates than multifamily, industrial, and some office assets. But retail NOI, net operating income, has outperformed expectations, a theme supported by PwC's emerging trends reports and CBRE's retail outlook data. Rate cuts accelerate the repricing of this asset class. Here's how investors typically evaluate opportunities in a rate cut environment. Institutional investors ask, what's the spread between cap rates and our borrowing costs? Is there room for cap rate compression over the next 12 to 24 months? Which asset classes give us durable NOI? And where can we deploy at scale with less volatility? Shopping centers often check all these boxes. Retail investors ask, can this investment produce stable income? Does the strategy benefit from lower rates? Is now a better entry point than 6 months from now? In a rate cut environment, the answer is often yes, because deal flow increases, leverage improves, value add plays sharpen, and refinancing events become more favorable. At Rockstep Capital, we invest in value add and necessity-based shopping centers, an asset class that historically performs well during rate easing cycle. Here's how the Fed's cuts strengthens our strategy. Number one, more attractive buying opportunities. We can acquire well-located retail below and often well below replacement cost. Number two, stronger leasing and tenant demand. Lower rates lead to economic expansion, which leads to faster lease-up, which leads to higher NOI. Number three, refinancing becomes more accretive. As assets are stabilized, refinancing into a lower rate environment can improve cash flow, increase investor distributions, boost the IRR at the fund level. Number four, value-add projects become more profitable. Every dollar invested in redevelopment yields more return when the cost of capital is lower. For both institutional and retail investors, this is the moment where early positioning matters most. Rate cuts don't guarantee returns. What they offer is opportunity. Opportunity to acquire before the market reprices. Opportunity to finance more efficiently. Opportunity to generate stronger long-term yield from durable assets. Shopping centers, especially necessity-based retail, sit at the intersection of stable cash flow, value-add upside, strong tenant demand, and now a more favorable cost of capital. Smart capital moves early in cycles like this. If this is a moment you're evaluating, we'd be happy to walk you through how our strategy aligns with what the market is signaling right now.